This has been a wild week to say the least. One of the wildest weeks I've seen in 20-something years. Let's start out with the political shenanigans. Trump calling out Jerome Powell, calling him names of stupid, too late Powell, and how does Jerome Powell react? After all the criticism Jerome Powell got, after all the name calling he received, he decides to keep rates unchanged. With tariffs set to impact goods, Jerome Powell sees higher inflation, slower economic growth, and a very uncertain economy heading forward with multiple wars taking place. Now, if you were just to read this headline of higher inflation and slower economic growth, this would be called stagflation, but the Feds refuse to use any sort of lingo that would cause markets to panic. But let's call it as we see it here. If they're projecting out higher inflation and slower economic growth with the possibility of unemployment ticking up to about 4.5%, then we know that this could be stagflation. They were wrong to call it transitory, and now they're starting to see a higher inflation, and they think that inflation will get under control by 2026. But they also said that this inflation should get under control by 2025, and that has not been the case. Now, while all this is taking place, we also have Israel and Iran at war. The latest attack wounded over 200, as the attacks between Israel and Iran are starting to intensify, and President Trump has not made an official timetable deciding whether the US is going to join forces here. And that's something that is also on the table. Now, if you watched any of his interviews, it definitely seems like the US is going to get involved at some point in time, but with no timetable given, because Trump wants to keep this as secretive as possible. But I do think there's a probability that the US gets involved sooner than later, and I think it could come as soon as this weekend. Now, if this wasn't enough to digest, we still have the Russia-Ukraine war, as the recent Russian attack kills 15 and injures 156. Now, while all this is taking place, you would think this would be a lot for the stock market to digest. But if you were just asleep at the wheel for the last 6 months, you're basically looking at a flat market. Yes, very volatile, but regained its losses. In those 6 months, you watched the 2-year yield go from about 4.4 down to about 3.9, which could have actually justified, in my opinion, Feds cutting rates by about 25 basis points to follow the 2-year treasury, but they did not do so as they're projecting inflation to tick back up. And in that 6-month period, you're also seeing the 10-year stay pretty much even keel here. It was trading close to 4.5% and still trading right around 4.4 to about 4.45%. So yes, it's dipped a few percentage points, but nothing catastrophic here. So with all these uncertainties taking place, multiple wars, inflation remaining higher for longer, unemployment set to go up a little bit higher, we've watched a market basically trade flat for the last 6 months. Now, in my opinion, I think one of the things that's keeping the market optimistic is the big, beautiful bill that's going to be passed. Now, this bill is supposedly going to add about $2 trillion over the next decade, and this is not including the interest payments that the US has to pay. And if we just take a look at history here, we want to look at the debt to GDP. 1960s, it was around 50%, 1980s around 34%, 2000s around 57%, and here we are today sitting at 123% debt to GDP, and that is inclining with the new bill that could be getting passed here. We created DOGE to cut spending, but then we're re-spending once again, which is kind of leaving me a little confused. I did like the idea of getting debt to GDP down. I do think that would have dampened stock performance, but in the end, I definitely think we have to go through ups and downs, ebbs and flows of financial markets, and we have yet to really have that downward move. We are only halfway through the year, and there's already been 157 IPOs. Now, obviously, this is no comparison to 2020 or 2021, and this is where I really started seeing the problems formulate within the stock market, and that's why I think we've had a massive correction. A lot of companies were overvalued. We heard the new SPAC deals coming out. And here we are today, though. Take a look at what's taking place. We are starting to see a pretty substantial peak up in the IPO market, which is allowing us to know that there is still a lot of liquidity in this market. And in my opinion, it's definitely been due to overstimulating the economy. When you're running balance sheets over $2 trillion a year, and now you got a new bill being passed that's going to add about a $2.8 trillion of stimulus, then we are going to see those financial markets take advantage of high liquidity within the market. And I think we're seeing that right now, as we're only halfway through the year and we got 157 IPOs going. And the one that comes to mind is this Circle IPO here. I believe it was supposed to IPO around 50 a share, and here we are now trading over $211 a share. Now, once again, going through that 6-month period, we saw that stocks are fairly flat, yields are pretty much tamed, but gold is still on a tremendous run. Over the last 6 months, gold is pushing nearly 30%. This is a rock that does nothing, that has produced outsized gains over the last couple years. So that's telling me something is definitely brewing here. Yes, markets can be irrational, and I think when you flush them with liquidity, rationale goes out the window, but something is definitely taking place with the gold market. Central banks are buying gold at historic levels. Are they preparing for something that we don't see coming? And I definitely think something's up here, and I think you have to pay attention to this. We've also seen a spike in the VIX, which could be people hedging a possible downward move here with multiple wars going on, political tension, a bill that's trying to get passed. There's definitely multiple reasons why you want to hedge to some volatility. And so we've seen a nice spike in the VIX with an S&P trading back to 26 times earnings. We know the Feds are talking about inflation remaining higher. We see that unemployment could actually tick up a little bit higher as well. But yet the markets are not budging here. They're trading for a premium and they're expecting earnings growth to be in double-digit territory next year. I just don't know if this is the case. And even with all this taking place, underneath, if we take out the Magnificent Seven, it has definitely been a pretty interesting market when we look underneath the hood. Over the last 6 months, we've really watched utilities outperform, industrials outperform, financials outperform, and energy over the last couple of days have come alive with these wars taking place. Could we see an energy crisis take place? While consumer staples historically has been a safe place to hide, in this market, it really hasn't been. I've seen names like Conagra Brands and Smuckers be trading at 5-year lows and really having a hard time maneuvering these tariffs, low margin business, and a shift in the consumer that could be a long-term shift here. A lot of the snack names are suffering from sales decreases as people are becoming a lot more health conscious, paying attention to what kind of dyes are in their food, and this is having a massive impact on consumer staples. So as we're starting to reapproach historical valuations in an uncertain market where unemployment could definitely be ticking up and inflation could actually be remaining a little bit stickier, in my next video, I actually want to talk about a few different names that I'm going to be adding to the portfolio here. As always, appreciate your time. We will see you all in the next.